Hey everyone, welcome back to Corporate Decoder, the place where we turn confusing corporate reports into something you can actually understand. Today we are looking at a quarterly report, so expect a wild ride of numbers and maybe a surprise or two about how this company is doing. And before we dive in, if you are tired of financial jargon and like seeing companies for what they really are, remember to subscribe. Also, join our Discord community linked in the description to discuss this and other companies with fellow corporate decoders. So what is the story this time? We are looking at PLAYSTUDIOS ticker symbol key and their report for the first 3 months of 2025. This is a company that makes free-to-play games, the kind you download on your phone. They make money when people buy virtual coins or watch ads in those games. Let's see if they leveled up or if it is game over for this quarter. This report is called a 10Q, which is what companies file every quarter to give everyone an update on how things are going. First off, there were about 108 million shares of Class A common stock outstanding and about 16 million shares of Class B. Basically, this tells us who owns the company and how much power they have. Before we get too deep, it is worth mentioning that this report includes what they call forward-looking statements. These are basically guesses about the future. The company is saying, hey, here is what we think is going to happen, but things might change. They are not promising anything. They list a bunch of things that could affect their future, from how well their games do to global events. All right, let's look at the money. Here is their balance sheet. Think of it as a snapshot of what they own and what they owe. They have got almost $30 million in receivables, which is money owed to them. On the other hand, their property and equipment, what they own, like computers and office stuff, is around $15 million, which is a slight decrease since the end of last year. They also have over $3 million in accounts payable, that is money they owe WPool. In total, they have almost $70 million in liabilities, meaning what they owe, but they have around $313 million in total assets. So they have got more than they owe. They are not about to go broke tomorrow. Looking at the stockholders' equity section, which is the value of the company owned by the shareholders, they have got no preferred stock, around $11,000 of Class A common stock, and around $2,000 of Class B common stock. That isn't really the important figure though. What is important is the additional paid in capital at $631 million and accumulated deficit. Negative $34 million in accumulated deficit. Negative $31 million and accumulated deficit. Negative $34 million in accumulated deficit. Negative $31 million in accumulated deficit. Negative $31 million accumulated deficit. Negative $34 million in accumulated deficit. Negative $34 million into accumulated deficit. Negative $34 million. It all comes up to around $244 million in accumulated deficit. Negative $34 million. It all comes up to around $244 million in accumulated deficit. Negative $34 million. It all comes up to around $244 million in equity. Next up is the statement of operations. This is where we see how much money they made or lost over the last 3 months. Their net revenue or total sales was around $62 million. That is down from almost $78 million for the same period last year. So they are selling less stuff. Their cost of revenue, which is what it cost them to make their games available, was about $15 million, less than the $18 million from last year. Selling and marketing cost them around $13 million, less than the $18 million last year. They spent $13 million on research and development to come up with new games or enhance old ones, less than $18 million last year. General and administrative costs were at $11 million, which is the cost of running the company. Depreciation and amortization, which is the decline in value of their assets, was almost $10 million. After all that, their operating loss, that is before you consider interest and other financial stuff, was almost $3 million. They made a bit of money in interest at almost $1 million. After paying taxes, their net loss, how much they lost overall, was almost $3 million. Last year, it was only about $500,000. This translates to a loss of 2 cents per share. Next, we have something called comprehensive loss. It is net loss with some extra items. Turns out the total comprehensive loss is almost $3 million. Last year, it was around $1.6 million. Finally, we have the statement of cash flows. This tells us how much cash they have coming in and going out. They started with a net loss of almost $3 million. Then they had some non-cash expenses like depreciation, adding almost $10 million back in. Stock-based compensation, paying employees with stock, added over $4 million. After a bunch of adjustments, they end up with about $3.3 million in cash from operations. They spent around $3.6 million on investing activities, mainly on buying equipment and software. Finally, they used about $2.4 million in financing activities, mostly buying back their own stock. Overall, their cash went down by almost $3 million. Next, the report talks about different parts of their business, what they call segments. They have two main segments, PlayGames, which is their main games business, and PLAYSTUDIOS, which is the rewards program connected to those games. This helps to see how each part of the business is doing. Net revenue for PlayGames was almost $63 million and $144,000 for PLAYSTUDIOS. They also went through some restructuring, so it cost them around $489,000. They bought some assets from a company called Pixode Games Limited. This was to get some new games for your phone in the more casual genre. The total price could go up to $113 million if the new games do really well. At closing, the price was only $3.05 and $5.30 GAN. There's a marketing agreement with MGM Resorts International. Remember, they mentioned a board member who's also at MGM. Most of their receivables are from Apple and Google. The company mentions something called fair value, which is how much certain debts are worth. In this case, it relates to things like warrants and contingent consideration from the Pixode acquisition. They also own property and equipment, mostly in the United States and Europe. They also have intangible assets, things you can't touch, like licenses and software. These are worth millions, but they lose value over time through something called amortization. They have some pending legal issues, including a class action lawsuit, and have put aside money to cover potential losses. They have something called warrant liabilities, which have to do with some financial deals from the past when they became a public company. They are leasing office spaces. The cost is around $1 million for this quarter. They have a credit line they can use if they need money, but as of right now, they have not borrowed anything. Their income tax expense was a little over $300,000 for the quarter. Some things like stock options could dilute the value of the stock, but they were not significant enough to matter this quarter. And finally, we have the signatures from the top executives basically saying, yep, this is all true to the best of our knowledge. Here's a quick recap of the financials. Their revenue is down and their losses are up. This is not great news. They point to some key metrics: DAU, MEU, DPU, ARPDAU. These are all down or flat except ARPDAU, the average money made per average user. These metrics are critical to their performance. What does all this mean? Overall, PLAYSTUDIOS had a tough quarter. Their revenues are down, especially advertising revenue, which is a big hit, and their losses have increased. One of the strengths to the company is its focus on reducing costs. Their cost-cutting measures are helping them navigate a difficult period, but they need to find ways to boost revenue. There are some key risks they are talking about. They have legal battles, which can be expensive. Their PlayStudios system is dependent on partners. One thing that would also help them is finding a successful new game. PlayStudios needs to prove it can adapt and grow in a market that is clearly shifting. They have cash, they have know-how, but now they need to show they can execute art. What's your take on these numbers? If you found this breakdown helpful, hit that like button and subscribe for more. Also, do not forget to join our Discord community. Thanks for watching, and I will see you in the next video.